Hi and welcome to the Accountant's Room. Today let's discuss about IFRS 8 intangible assets as adopted by the International Accounting Standard Board in April 2001 with latest amendments be done in April 2014. Well, the objective of this standard is to prescribe the accounting treatment for intangible assets that are not dealt with specifically in another standard. So in this review, we're going to see the definitions related to the standard and recognition criteria for an item to be treated as intangible assets in financial statements, and the initial and subsequent measurements, as well as treatment of research and development costs that are related to internally generated intangible assets. Now let's see on the definitions. Well, an asset is defined as present economic resource controlled by the entity as a result of past events. And an economic resource is the right that has the potential to produce economic benefits. Well, an intangible asset is defined as identifiable non-monetary assets without physical substance. So here we have like three features of intangible assets. First, it does not have physical substance. That means we cannot see or touch. And second, it is non-monetary asset. Means it is an asset that cannot be easily converted into cash. When we speak about monetary assets, we refer to assets like cash at hand, cash at bank, and account receivables. So the monetary assets do not form part of intangible assets. So intangible assets, it has to be non-monetary. And third, it has to be identifiable. When we say about identifiability, we mean it can be separated and sold, separated from the entity, and can be sold or transferred to another entity, or it's a result of legal or contractual obligations. So examples of intangible assets are import quotas, software license, acquired goodwill, patent rights, and copyrights. Okay, now let's see on the recognition of intangible assets. So an item shall be recognized as intangible assets if it meets first the definition of intangible assets and the recognition criteria. As discussed before, intangible asset is identifiable non-monetary asset without physical substance. So now let's see on the recognition criteria for intangible assets. Okay, so IAS 8 requires an item to be recognized as intangible asset if it meets the following. First, the identifiability feature. So identifiability feature, we said about the asset is identifiable when it can be separated from the entity and be sold, transferred, licensed, rented, and whatever. So, and second, when you say about identifiability, we mean that the asset has arise as a result of contractual or legal rights, regardless of whether those rights can be transferred or separated from the entity to another entity. So here we have one point to note about advertising costs. So advertising costs can result to economic benefit to the entity. Economic benefit to the entity, yes, but they cannot be separated from the entity from which the advertising was made. They cannot be separated and sold or transferred to another entity. So advertising costs, despite that they have economic benefits to the entity, they cannot be treated as intangible assets because they do not meet the identifiability criteria. Now, the second criteria is control over the asset. So the entity controls the asset if it has power to obtain future economic benefits, and second, it has power to restrict the access of others to those benefits. So when if the entity has a certain software which has made it available to the public at free, so this cannot be termed as intangible asset because despite that because the entity does not have benefits that do not benefit from that asset, and and anyone can access it at any time. So, for the asset to be termed as intangible asset, it has to be result to future economic benefit to the entity, and the entity has power to restrict others from using it. Okay, so we have one point here about staff training cost. So staff training cost can result to future economic benefits to the entity due to increase the skills of the staffs However, the entity do not have power to restrict the staff movement. Let's say if a staff want to resign and go to another entity, so it can live with the skills acquired and use it to another entity. So we cannot term staff training as intangible asset. Uh, However, if there is restriction on the staff movement, maybe if a certain staff has acquired the skills and is not supposed to leave the entity for like 5 years, so for that period we can recognize it as intangible asset because the entity controls the movement of that personnel. The third point is the existence of future economic benefits. So the entire item will be recognized as intangible asset if it can result to future economic benefits to the entity. And this refers to revenue from the sale of products, cost saving, and other benefits resulting from the use of the asset. Okay, now as per A38, an intangible asset shall be recognized if and only if it is probable that the future economic benefits will fall to the entity and the cost of an asset can be measured reliably. And the entity shall assess the probability of expected future economic benefits using the reasonable and supportable assumptions that represent the best management estimate set of economic benefits that will exist for the useful life of the asset. Well, now let's see on the measurement. Here we have initial and subsequent measurement. Okay, now let's see on how the item is initially recognized in the financial statements. As per A38, intangible assets are initially measured at cost, and this will depend on the mode of acquisition of that intangible asset. Well, if an asset is separately acquired, example, partial purchase, this is going to be measured at cost. And cost comprises of purchase price, including import duties, non-refundable tax, uh, after deducting trade discounts and rebates. And also, it should include the directly attributable cost of preparing the asset for its intended use. So here we talk about the employee benefits, professional fees that arise directly from bringing the asset into working condition, as well as cost of testing the asset whether it's functioning properly. And also we have costs which should not be included as part of the purchase price. Uh, Costs like those of introducing the new product or service, cost of conducting business in a new location or with new class of customers, administration and other general overhead costs, initial operating losses, and interest and other borrowing costs that are not covered in AS 23. So these costs should not form part of the purchase cost of the asset. And recognition of the cost in the carrying amount of intangible assets will cease when an asset is necessary for being capable to operate as in the manner intended by the management. Well, point number two, if an asset is acquired in a business combination, this is initially going to be measured at fair value on acquisition date, as explained in the FRS 3 business combination. Well, and if an asset is acquired by the way of government grant, for example, license to operate radio station or airport landing lights, so this is going to be measured at fair value or nominal amount plus any expenditure that are directly attributable to the preparing the asset for its intended use. Oh, so the treatment of asset as acquired by the government expenditure uh, is explained in detail in IAS 20, accounting for government grants and disclosure of government assistance. Well, point number four, if an intangible asset is acquired by exchange with other non-monetary assets, for example, a plot of land is given in exchange of a machine, that one entity gives a land in order to obtain a machine. So this is going to be measured at fair value unless the transaction lacks commercial substance and the fair value of both assets, meaning the asset given out and the asset received, cannot be measured reliably. So if it happens that the exchange lack commercial substance or we cannot measure the fair value of both assets, then the asset is going to be measured at the carry amount of the asset given out. Now Let's see on the subsequent measurement of intangible assets. Well, after initial recognition, intangible assets are thereafter being carried at either cost model or evaluation model. So what is cost model? In cost model, an asset is carried at cost less accumulated amortization cost and accumulated impairment loss. Well, amortization is a systematic allocation of a depreciable amount of an asset over its useful life by reflecting the pattern of economic benefit an entity expects to consume or by straight line method. So amortization is similar to depreciation as in PPE, but here in intangible asset we use the term amortization. So we are going to take the depreciable amount of an asset and we allocate it by using the to the useful life of an asset. And the useful life of an asset refers to a period of time for which the asset is expected to be used or the number of production or similar units expected to be obtained from the use of the asset. Well, an impairment loss is the amount by which the carrying amount of an asset is higher than its recoverable amount. So in cost model, the asset is going to be carried at cost less accumulated amortization cost and accumulated impairment loss. Okay, now and in the valuation model, an asset is being carried at the value amount, means the fair value, the subsequent accumulated amortization, and the subsequent accumulated impairment loss. And how do we determine fair value in the valuation model? The fair value of intangible assets are determined with reference to identical assets in active market. And an active market is the market in which the assets traded are identical and there are willing buyers and sellers and the prices are available to the public. So, and if the intangible asset is being accounted as per the valuation model, all other assets in that class are also going to be used in the same model, means the valuation, unless there is no active market for that asset. So we're going to use, if there's no active market for the particular asset, then you're going to use the cost model. Now, how frequent do we revalue our assets? So the intangible assets will be revalued when the carrying amount of intangible assets differs significantly with its fair value. And after we have revalued our assets, we must either get the gain or loss on evaluation. So gain on evaluation is will be taken to the valuation reserve through other comprehensive income. But if the asset was previously revalued and there was a loss, so the gain obtained in this year is first going to is first going to be charged to the profit or loss account until the amount of loss previously occurred is exhausted, and the remainder is going to be taken to the revaluation reserve. And if the assets, if there is a revaluation loss, this is going to be taken to the profit or loss account. But if the asset was previously valued and there was a gain, so this loss is first going to exhaust the valuation reserve up to an amount of gain previously occurred, and the remainder of loss is going to be taken to the profit or loss account. And after the evaluation, an intangible asset should continue to be amortized by allocating the new value to the remaining useful life. And also I-38 allows the entity to perform a reserve transfer equal to an amount of excess amortization from the reversion reserve to retained earnings. So when you speak about excess amortization, you mean the change of amortization of an asset as a result of revaluation. Maybe before revaluation you had amortization of 2 million, but right now there is 3 million as amortization. So the difference is going to be taken from the reversion reserve to retained earnings. Okay, now let's see on the treatment of intangible asset with infinite useful life. IAS 38 requires intangible asset with indefinite useful life not to be amortized. Rather, they're going to be tested for impairment annually, or when there's an indication that the asset might have been impaired. And these assets should be periodically reviewed to see whether we should continue to treat it with indefinite useful life. And if there are any changes, maybe in the useful life of that asset, these changes are going to be accounted and as per IAS 8 change in accounting estimate.